Very good. There we go. Fantastic. Okay. Good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. I'm delighted today to be joined by Paul Horsnell, Head of Commodities Research at Standard Chartered, Daniel Richards, MENA Economist at Emirates NBD, and Vibhuti Gurg, Director of South Asia at the IEEFA. Thanks so much, everyone, for joining us. Let's start, Daniel, perhaps with you, and talk a little bit about, Fed banking. I mean, I've got two bankers here with us today, so it'll be interesting to see what your perspectives are in terms of how the financial markets, the banking market, might be influencing, oil sentiment, if you like, and principally really on the interest rate front and what we see happening next year. So, Daniel, just give us your perspective on sort of what the up-to-date expectation is of interest rate policy from the Fed translating, obviously, across the world and how that's impacting demand.
Sure. So last night we had the FOMC minutes from the November 1st meeting, and there wasn't really anything within that would change our view. We've held that, I think, a pretty widely accepted view now that the rate hiking cycle has now come to an end. It's pretty unlikely we'll see any further hikes. But that being said, I think the higher for longer narrative does remain in play. We're not expecting any cuts through till towards the end of the first half of next year. When we look at the minutes from last night, it was quite, and they said this in a statement following that November 1st meeting. They really highlighted that those higher yields, Treasury yields, were doing their job for them. We had that run up ahead of November 1st, but then they came off quite sharply following that meeting. So taking away some of that tightening that was doing a job for them. So I think any expectation of a pivot coming soon is far too early, especially, they have something of a credibility gap following the whole transitory debacle, which obviously inflation was not. It is now coming down, but it's still above where they would like it to be. And there still remain potential upside surprises on that front. So, and we'd expect likewise for the other major central banks. We don't expect any more hikes, but again, we don't expect cuts to come probably after the Fed. We'd expect the Fed to likely be the first mover on that. And obviously, the UK saw inflation come down pretty sharply on that last print. Rishi Sunak was able to say that he'd achieved one of his targets, at least in halving inflation. But again, it's still far above where we'd like it to be. So I think, yes, hiking cycles are over, but it's going to remain tighter for longer. That phrase remains in play, I think.
Okay, thanks, Daniel. Paul, let's go to you, based in the UK, and give us your perspective on that. Like Daniel just said, Europe and UK are following the Fed's following in the Fed's footsteps. But we have seen, we saw worse inflation in Europe, but obviously some progress on bringing that down. What is the sentiment there? I mean, the ECB also did indicate it was going to slow down before the Fed at one point a couple of months ago. So again, how is that impacting the demand sentiment going forward?
Yeah, I think I'm trying to more from the view of the oil market. I mean, the oil market's sentiment and view of central bank moves is clearly very much still towards the pessimistic. I think perhaps a more pessimistic scenario perhaps than is actually baked into rates markets at the moment. But it certainly pushes us back into that sort of market circumstances we were in at the start of last year, where any form of economic data, particularly US data, proved to be negative for oil prices. Because if it was a weak bit of data, we say, oil demand's going to fall because the data's weak. If the data was strong, they say, rates are going to rise, and that's bad for asset markets. And so any sort of deviation of data from consensus tend to be greeted in the oil market with selling. And we've moved a little bit back towards that, I think, in the past month, with if you go to traders and try to back out what is their view of the Fed. That's not really particularly an exciting view of the Fed, but it is one that So rather suggest that whatever the Fed is doing, that must be bad for oil because it involves either a weaker economy or a higher interest rate. So I think a lot of confusion in there in a market which is still very much led by macro-led hedge funds. So there isn't much coming from the commodity markets itself on the speculative side, and the speculators reacting, I think very much in line with the interpretation that Daniel went through. I thought that's a very good summary.
Okay, yeah, and we have actually an interview coming up to play in an hour after the podcast with a gentleman who is very much on the technical financial hedge fund side of the business. And one point he made was, fundamentals are playing a part, geopolitical risk is playing a part, but really it's these algorithms and computers that are making the decisions on where the oil price goes at the moment in terms of money, managed money. So how much control can OPEC have and others? Vibhuti, good morning again. Give us your perspective from Asia, from India, in terms of, what the outlook there is again for demand. I mean, India has been, doing very well as an economy this year, unlike some others where there's been some more warning signs around. Oil is back under $80 pretty much. India should be happy, right? Do you expect that to impact how much oil you take, how much Russian oil India takes, etc.?
Well, yes, the Indian economy has been doing really well because we have an increasing population with an increasing growth which we are witnessing. So definitely in terms of our reliance on Russian imports, well, because of the discounted price that was being offered in the last couple of months, yes, our Russian oil imports went up. But October this year, and in fact from August onwards, we are seeing a decline in the Russian imports. And last month, particularly, we saw an increasing amount of imports from Saudi Arabia. So I think even in our previous editions, the point I have been making is India is a very price-sensitive economy. So what really matters for India is as long as they are getting a good price for imports, because we are importing more than 90% of our oil from other countries. So the reliance is huge. And if we really have to control inflation, definitely prices make a lot of matter. And as a result, it's the inflation in the country has gone down. So in October, the retail inflation was 4.87%, and the central bank is targeting at 4%. So we are getting into the range. Whereas early this year, we saw prices the inflation going up to as high as 7 and 8%, which was beyond the 2 to 6% band, which is more acceptable. So definitely with stronger drivers, which are leading to higher economic growth and decline in oil prices, have really been now helping the Indian economy to grow at a level which does not imply increasing fiscal deficit for the government, because earlier, while the economy was still growing, the fiscal deficit was increasing at the same time. Yes.
Because of energy costs, if nothing else. Thanks, Vibhuti. Daniel, let's talk a bit about OPEC policy, but in the context of revenue for Saudi Arabia. Obviously it's been cutting production more than other people. It's going to extend those cuts. Expectation is they're going to extend the voluntary cuts into next year. And now there's talk of, will they have to cut more? Many people saying that Saudis are going to have to do that alone again. Mm-hmm. How does that impact their budget? I mean, we had already an impact this year. What's that going to do to their thinking, if you like? It's not an endless pot where they can go to deficit further and further, is it?
No, it's certainly not an endless pot, but at the same time, I don't think that pot's at risk of running out anytime soon, especially after that bonanza windfall they had last year. We did have three-quarter budget figures come out a week or two ago. Obviously, they showed a pretty sizable decline in oil revenues, down around 20-25% and 35% year on year for the third quarter, which is not surprising. By contrast, everything else is performing pretty well. Non-oil revenues were up very strongly. How long that can be maintained? Obviously, the oil sector remains the driver of this investment into its non-oil diversification strategies. So we do expect a budget deficit this year and next, around 2% of GDP this year compared to surplus last year. A surprise surplus 2.5% last year. And indeed, like when they released those Q3 budget figures, the projections were also from Saudi Arabia for a surplus over the next several years, in contrast to where they had been previously. So it is a reality that I think they are facing up to. They are cognizant of what this means. At the same time, though, I don't think there's any particular likelihood of a slowdown in this spending spree anytime soon. I think they're still able to withstand it for the next several years at least, and given the heavy focus that has been put on this and the high profile of many of these strategies, I don't expect there to be any reversal of these plans as yet.
Okay, thanks. Paul, just in terms of the oil price, which has obviously taken a bit of a hit, and taking into account that the geopolitical risk is minimal. But I had somebody, again, the same interview yesterday, and the gentleman was saying, well, yes, geopolitical risk has dampened, in terms of how it's manifesting on the oil price. But if we look at forward oil prices, the backwardation in the market as we look forward a few years, today's oil prices are not looking too bad in terms of support, from that. I mean, what would you say? Is oil cheap or is it not cheap? We've got these different points of view at the moment on that.
Oh, I think oil is cheap. I mean, it's the back of the curve is just too low. We start seeing back of the curve Brent prices at sort of $70, and then try to make this industry work in the long term at $70. It doesn't work. You end up with huge great supply gaps, too much demand, not enough supply. I think that's a market failure in a way, that the back end of the curve just isn't priced, partly because it's to do with the loss of liquidity at the back of the curve, partly it's to do with the way that markets trade and various structural features, but it doesn't seem like the right price. And I think if you go around most oil market commentators or analysts and say, what's the price of oil supposed to be in the long term, very few of them will be coming up with prices as low as the market is delivering. But so I wouldn't go, I suppose it's a glass half full or glass half empty thing. I wouldn't say, wow, prices are great now because look how low they're going to be in the future. It's not a prediction. It's a price, a value today for oil to deferred delivery. So I think it has to be taken, with a slight pinch of salt. I would say current prices are low.
Are low. So would you agree that, I mean, as some traders are predicting that we've gone a bit lower, could touch yet another lower level of support, but then we're going to see, with all the stuff going on in the world, regardless of supply, but inflation is going to stay. We've got these wars going on and conflicts, that next year we are going to see, oil prices skyrocket. Would you subscribe to that?
Yeah, I mean, I'm not a technical analyst, and the idea of going down again to get to touch support is more to clean up the technical charts, and it's certainly on technical charts. So yes, it looks pretty strong if you do put in that further support. I think on a more fundamental basis, you look at last year, they're up to next year. There's two very opposing views, and one of the difficulties I think for OPEC Plus ministers is choosing, which view do they go for? Do they go for the more positive one, which I'll come on to, the more negative one, or the one that the market seems to be reacting to, which is a totally different creature? But I think if you take the sort of positive numbers, those, for instance, forecast the OPEC Secretariat, those numbers imply that the Saudi Arabia's voluntary cuts can be unwind completely and relatively quickly without the rest of the group necessarily having to cut output. I mean, that's the perfect base for being able to unwind the cuts and achieve a higher sustainable level of prices. Our own numbers are a little less positive than that, but not much, and we still have a call on OPEC for next year about 29.3, which is roughly 1.5 million barrels above October production. So again, pretty close to being able to do a full adjustment without necessarily having to sacrifice on price. Where you then start feeding in other scenarios, particularly the IEAs or the US EIAs, those are at the polar opposite. And they imply, particularly that the EIA one, that there is no room to do anything other than a barrel-for-barrel replacement of the Saudi voluntary cuts with target cuts from OPEC Plus as a whole. I mean, that's the process that has to happen. It's not sustainable, and it's unfair for Saudi Arabia to have to maintain that weight too much. There has to be a rebalancing, and other countries have to pull their weight a bit. Easy, I said, under those bullish scenarios, under the IEA, not so easy. And I think the market is actually pricing in something even worse. It's looking. The market doesn't really talk about balances anymore, but it is just the straightforward. Chinese demand's going to be terrible, US demand's going to be terrible. There's supply coming from Guyana, the usual sort of very partial adding up of bits. And so I think the market is probably currently pricing in scenarios which are worse even than those more bearish ones. So which one do you react to? In the long term, you're going to go for the right one because that's where we get to. But in the short term, do you react to a market which has got itself confused? It's overly pessimistic. It doesn't know what to do about economic data, doesn't know what to do about oil data, and it's very, very, and speculators are extremely short. So I think that raises a kind of short-term question about policy rather than some of those longer-term issues.
Yeah, and also you've got these, potential black swan events coming to again next year. But the ones that have happened this year have certainly not rocked the boat too much. Thanks very much for that, Paul. Vibhuti, let's talk a bit about India again in terms of gas, gas prices and how those are filtering in through to your economy as winter approaches. Obviously, there's other things that influence gas prices, Asian demand in general. We don't seem to have a supply issue. We've still got the US willing to send LNG cargoes to the region. What's the outlook for that? And is there any trepidation that prices could spike for the Indian economy?
In India, in October, again, we have witnessed high gas demand, and that was fueled largely by the power sector and the refining sector. Although if you look at the consumption, it's largely dominated from the fertilizer sector, and then, CGD, which is the city gas network, and then power and refining. But last month, we saw the demand increasing for the power and the refining sector so much. Definitely, India, again, is the gas prices are dominated what's happening globally, because, again, we are importing a lot of our gas requirements, again, from other countries because of limited availability of domestic gas. So as a result, we did see government kind of, increasing the subsidies for the fertilizer sector, because definitely, as I said, gas consumption is highest in the fertilizer sector in India, and they can't pass on the increased gas prices to the agricultural consumer. So that means government subsidy burden goes up quite substantially when the gas prices go up globally. So it has a lot of implications for the Indian budget when the gas prices go up. While we are not like a very gas-dominated economy, but still the impacts on certain sectors, especially from the food security perspective, it becomes very, very critical how India manages the impact of high gas prices. So from that perspective, we are kind of witnessing an increased burden, and especially next year with elections around the corner. Government is coming up with a lot of SOPs in the form of, LPG subsidies, because clean cooking is something which the government wants to promote. But at the same time, the LPG prices have gone over the roof. So government is started announcing some kind of relief in terms of price corrections or lowering of prices for LPG. And if the gas prices in the coming months go up, which means government is going to come up with higher gas price support for LPG. So yeah, these are some of the repercussions which we are seeing on the Indian economy.
Okay, thanks, Vibhuti. Daniel, let's talk a bit about inflation again, but specifically with, in terms of the Gulf. I mean, we started by talking about interest rates, inflation, Europe, US. Inflation's coming down in Europe a little bit this year, and it has done so apparently in the US, but I'm not feeling here that inflation is under control in the Gulf. If anything, the opposite. So it's we have to look at it a bit separately, don't we? There's a different dynamic here and different model. Any concern about that we're being, people are being outpriced, and how can we in any way control that?
Yeah, certainly, of course, inflation is always your mileage may vary issue, right? It depends on what your basket contains. And lots of people have been looking at the figures from Dubai in particular. We've not had the UAE CPI print, but the Dubai print, which is at 1% year on year several months ago, which many people felt did not reflect the reality on the ground when they're seeing their rent or their housing costs in particular head up very sharply. We're still waiting on the latest print. I think it's a little bit late, but the last one was 3.8% year on year. Has been heading higher, but that is reflective of the transport sector rather than anything else. Housing prices are starting to feed through, but still not kind of to a level that you'd expect them to be. So we're trying to work out exactly what is included in that because, you know, as you say, people are finding things are getting more expensive. And it's not just housing, but starting to feed through more as well. Household durables and services are also one of the key drivers of the price growth. I think both of those are somewhat reflective of what has, to all appearances, been pretty substantial population growth over the last 18 months, 2 years or so. That is seemingly feeding through into the CPI basket, not only through that housing element, which, you know, as I say, perhaps isn't being reflected as you would expect, but certainly in household durables, in terms of, you know, eating out services. And for many people are finding a pension, like you say, are potentially being priced out, not necessarily the city, but perhaps people aren't going to be able to afford to live in areas, districts that perhaps they might have been able to a year or two ago.
I mean, just to go back to, you know, Paul, inflation again back in the UK, you know, the cost of living crisis that was there, yes, you know, exactly a year ago. You know, that's disappeared, hasn't it? People aren't talking about that again. Is there any trepidation that it's coming, you know, as winter approaches, that we're going to have a similar scenario as we did last year?
I think it's still an issue, perhaps in a different way. I mean, you're right, the inflation rate is halved, and it's down to 5%. But I've never met anybody who says, you know, I'm really, really happy because I've noticed that prices are only going up half as fast as they were last year. I mean, what people notice is that prices went up last year and they've gone up again this year. You know, so, and even a return to zero inflation, you still end up at a higher price, and people do notice. And you do hear some people talking on the edges of such things like shrinkflation. You're getting the same chocolate bar. You know, the price hasn't gone up, but the chocolate bar itself is 20% smaller. There's a lot of shrinkflation. Bits of butter, which are 200 grams when they used to be 250 grams. So there's always muttering in there that, you know, you're not getting value for money. I think the key thing about whether it's an issue is, you know, has the government, as the UK government, received any particular boost in the polls yet from the fall in inflation? And so far, you know, they're so far behind it, it's quite difficult to disaggregate, but it doesn't look as if there's been a particular political bonus from halving inflation, which implies, you know, again, most people are perhaps thinking, as I suggested, that look, they're still going up, and you know, it was tough to get things to work on a low income in a low income household already, and then we've had 2 years of higher inflation, and conditions for a lot of people, I think, are still extremely difficult. So definitely not over, but perhaps out of the headlines a bit.
Okay, and Dan, just back to you, Daniel, just briefly on the impact of inflation and rates, if you like, on corporate earnings. I mean, in the US, we see people saying that the trickle effect of the high rates we've had for over a year now, the higher rates, they're not too high, will actually start to manifest in corporate debt, etc., next year. In the Gulf, do we have anything like that? Is that trickling through at all as a concern for companies?
I think there has been an element that's weighed on credit growth, certainly. There has been, you know, liquidity has been very high, deposits have grown very strongly, but borrowing hasn't really kept pace. And I'm certain that that must be in part reflective of a higher rate. So firms are able to avoid it, or they can put their growth or expansion plans on hold a little, but I think they have done. Obviously, you know, that will start to weigh on growth down the line if that lack of business investment, or if it is the fact they are not investing through not borrowing. If they're investing through other ways, obviously it mitigates it. But certainly credit growth has not been where we might have expected it to be in this environment. We haven't seen the kind of rise in bankruptcies here that you've seen, quite strongly in Germany and the UK. I think we've seen figures in recent weeks that those kind of figures, firms are struggling much more. It is still a growth environment here. We had a PMI survey at 4.5-year high. On the latest print. It's still a pretty strong environment, but I think that slow credit growth is reflective of those higher rates.
Okay, thanks, Daniel. There's the survey question for today, which we sort of started talking about earlier. Fed rate cut will not happen till at least the second half of 2024. There's been so much debate around it month to month, but a lot of people have recently said that no matter what, the Fed is kind of finally getting somewhere with its policy, and it's gonna hold. But never say never, I suppose. But till at least the second half. And the question, I suppose, is then what? It may cut by up to 1% or more. So agree or disagree, it definitely won't happen in the first half of the year. So everyone will get the result of that. Vibhuti, just in terms of again, sort of the financial situation of the Indian government, I mean, and in terms of budget for expenditure, the refining situation in India. Tell us a bit about the updates on any investments there. Obviously, you've got the private refineries. Is there an appetite for that to sort of increase? Are we seeing the likes of Reliance, etc., sort of forecasting a larger market? What's the sentiment there? Given the refining capacity in Asia and generally, and what's happening there, particularly in China, for example, or the Middle East?
As far as the investments in the refining sector is concerned, definitely it's on the upswing. So while a lot of it is also being led by the private sector, the likes of Reliance, but also from the state government or the central government perspective, it's on the rise. So while we do expect even the share of gas in India to go from 6% to 15%, and we are seeing some level of increase. But higher gas prices will always be an issue in India because of being a developing nation. As I said, prices really matter. And if we are able to offer clean energy alternatives at a much cheaper price, so if there are other solutions that become as alternatives to gas, so our reliance on gas should go down. And I think that's what even IEA Outlook predicts, that the share of gas in the coming years is likely to go down because you'll have other cleaner energy alternatives available, which would be much cheaper. So going forward, so while the India is quite upbeat and is expanding its refining capacity, but my sense is it's going to lead to a lot of stranded assets going forward if you are going to increase capacity to the extent while the demand for gas is going down. So right now, investments are going up, but I do feel that we need to take it with a pinch of salt because the gas demand, as per different, even the IEA, as I said, is expecting to go down.
Okay, and while we have you, Vibhuti, on the program this week, we have COP28 coming up, starting here in the UAE in a week's time. What expectations do you think India will have, or intentions, when it arrives, its country delegation, and particularly on this whole issue of coal, phasing down, phasing out, etc.? Where would you say would be the priorities for India as it goes into COP, and how much can it commit to what's being asked?
I think we missed the bus where all countries did not agree to complete phase out of fossil fuels, but the developed world was more, persistent that we should only be looking at coal phase out, which India and other developing economies who were relying on coal never agreed to. So they were okay with the language of all fossil fuel phase out, which would include gas, but somehow that never no consensus were reached. And I think this year, with all the Russia-Ukraine war, and now with the Palestine and the Israel war, so with all the global externalities that have led to India continuing its reliance on its domestic fuel, which is coal. And we have been hearing statements from the power minister that India is going to go all about an all fuel kind of an approach, where they are expecting more development of coal capacity as well. So I don't think so. While India is doing remarkably well as far as renewable energy is concerned, but they are still relying big on coal because they are expecting huge demand, which they are expecting the peak demand to go up from 240 gigawatt this year to 335 gigawatt by 2030, and they feel that they need to put up more coal-based capacity. While I have a different view, but speaking from the government's perspective, I think then they either might agree to all fossil fuel phase out kind of an approach, but definitely not coal phase out approach.
I suppose it's all now become a, you know, as you said, because of the geopolitical energy security risks, the transition argument has taken a bit of a turn where people are saying, well, yes, we will continue to invest in transition technologies, but we must also continue to invest in conventionals as well. And China is a big example of doing a very good job of that, continuing to use its coal, but investing heavily in renewables, etc. There's the result of our survey, a resounding agree second half. Let's see if everyone's right, 91% that it will not happen until at least then. Thanks very much. Thank you so much, everybody. Thanks, Vibhuti, for that. And to Paul and Daniel, I don't know if we'll see you at COP here in a week's time, but if you're coming our way, Paul and Vibhuti, please do let us know. And there we have our halftime talk interview for this week, which is with Mr. Butchev, which is on all about sort of oil prices and trading and what's influencing that. So well worth a watch in an hour's time. Thanks so much for everyone for joining us, and have a great day.
Thank you.
All the best.
Thank you.
Thank you.